Good morning, everyone, and welcome to the QuickFee Q1 FY24 Business Update Investor Webinar. On our call today, we have Dale Smorgon, Chair of QuickFee, Jennifer Warrawa, President North America, and Simon Yandel, CFO, to run through the presentation. And my name is Katie McKenzie, Investor Relations for QuickFee. The presentation will run for about 30 minutes, and then we'll open up for Q&A. We won't be using the hand-raising function, so if you have any questions, please type them into the Q&A tab at the top of the screen. If we don't have time to get through all questions today, then we'll reach out to you directly following the webinar. And now I'd like to hand over to Dale Smorgon.
Thanks, Katie. Thanks everyone for joining. A few words from me, just opening, and then I'm going to pass across to Simon and Jennifer to run the bulk of this morning's session. A really pleasing quarter, Q1 behind us. I think we continue to see really strong progress in our US business, together with the strong growth we're seeing out of our mature Australian business. So, you know, both operating divisions are performing well, and has led to a strong set of results for Q1. Of course, minimal credit losses as well throughout the period, which is a key feature of our full recourse model back with firms, and we'll touch more on that as we go through the presentation. If I could just ask you to advance the next slide, Katie, or Jennifer, if you're in control of that one, so we can just touch on that results overview. Group revenue up 31%, so on prior corresponding period to 4.2 million, led by US finance revenue up 62% on the prior period, and TTV up 23% from the US. In Oz, we've got revenue that increased by 54% from our finance product, which is terrific, and 11% increase on our US Pay Now TTV to $268 million for the quarter. I think one of the key features of what we put in place relative to the US, and Jennifer will talk more about this, is a new sales strategy, and it's delivering us early results. We had 44 new firms that signed up in the quarter, and I think importantly, half of those firms took QuickFee Finance, our highest margin product and our real growth engine for both revenue and EBIT. And so with changes to comp plans and changes to some of personnel and a robust sales strategy, we're optimistic about the future in terms of our growth delivery in the US. Together with the direct sales model, Jennifer will talk more about the exciting new partnerships, both Lineal and more recently Iris Software, which have the capability of driving exponential growth for the business. These relationships, together with others that we're working on, have been in gestation for many months. As you'd appreciate, these partnerships aren't easy to acquire, but we're certainly excited by the possibilities that they now bring for growth in the business. Third point is just on funding, in relation to Australian legal disbursements book, which has grown rapidly over the past 12 months. So we have secured a new $10 million funding facility. It does allow us to release $4.3 million of equity that was previously funding the growth in that loan disbursements book. Under the guidance of Bruce Coombs, who heads Australia, of course, and our founder, the Aussie business and particularly our legal disbursements funding book continues to grow rapidly, and we're delighted to have additional liquidity available through the finalisation of that funding facility. Simon can talk more about cash and headroom, but as at 30 September, we're at 6.6 million headroom, and so we're optimistic about the cash reserves in place and our capacity to continue to grow, both in Australia and of course via our Northleaf facility in the US. So we're tracking well. Of course, profitability is the objective. We know our second half of the financial year is going to be stronger than our first half historically, and we're certainly optimistic with the prospects of continuing to drive further growth across both operating business units. And so with that opening and a bit of a summary, why don't we dive into some detail, and I'll pass across to Simon, who can do that.
Thanks, Dale. And hello, everyone. Just a little bit more detail on the US. As Dale mentioned, the business delivered strong results in the quarter. Finance total transaction volumes, or TTV, was up 23% to $5.9 million US, and Pay Now TTV up 11% to $268 million US. Active customers in the US were up 8% in the quarter to 79,000, and US active firms were up 8% to 699. As Dale touched on, the new territory-based sales model, splitting the US into 3 regions and updated sales commission plans, are contributing not only to new firm acquisition, but also a focus on the high margin finance product. So, we're seeing that changing commission plan and focus really deliver strong growth in the finance product. Additionally, the demand for cash flow solutions from SMEs, despite rising interest rates, has delivered significant revenue yield improvements. And as Dale touched on, we continue to focus on credit risk, and we had 0 write-offs in the quarter, and that's in either the US and Australia. As a reminder, the firms we serve guarantee their clients' borrowings, so that underscores our low credit risk model. So on Australia, the Australian business also posted very strong results for the quarter, with 24% finance volume growth to $11 million and Pay Now volumes up 29%. We have seen robust demand in Australia from both firms and their clients. And again, despite rising interest rates and inflation, active customers in Australia were up 21% on PCP to 17,000, and active firm numbers remained relatively stable. The market is quite mature. We'll talk a little bit more about Australia later, but the growth is really coming from the demand from firms' clients. It's not shown on this slide, but our QPay Plan product, which provides finance to the homeowner services market and includes the Gyms Group franchise, grew strongly in Q1 as well, and with volumes up 200% to $0.6 million. On the next slide, we'll talk a little bit about the economics of our finance product. We showed this breakdown at the full year results, and it shows how we have 2 levers for finance revenue growth, both price and volume. The chart on the top right of this slide shows Australia's lending volume for Q1 FY23 and Q1 FY24. So the current quarter just finished on the right. Then the next 2 bars are the revenue yield % we make from that volume, which is revenue divided by volume. And on the far right, where the current quarter revenue growth over PCP has come from. In this last column, you can see that $0.3 million of revenue growth is from the higher volume lending, and another $0.3 million is from the increase in the rates we charge over and above the prior corresponding period's revenue of $1.1 million. So that totals 1.7. Similarly, in the US chart, bottom right, $0.1 million has come from volume growth, and $0.2 million has come from yield growth over prior year revenue. And I'll just point out that the top half, the Australia slides, are in Aussie dollars, and the bottom half are in US dollars. Interest revenue from lending does naturally increase as we write more loans, just based on the higher volume, but the interest rates that have increased, that we increased both in October 22 and July 2023, deliver the yield growth on top of that volume growth. So you can see, as we saw for the full year 23, in Q1 24, revenue has grown faster than volume in both markets. And as we recognise revenue over the course of the loans, and those loans run from about 9 to 12 months on average, there's a long tail of those higher yields still to be recognised in FY24 from loans that have already been written. And I guess the last point on the finance product is that we are able to increase interest rates without materially impacting demand. Excuse me. It's really due to the fact that it's very easy for clients to take out a payment plan. There are no credit checks or approvals. and the product is free to our firms. They get paid in full immediately, so they're very keen to promote that to their clients. On the next slide, just some summary of our Pay Now product. In the US, volume is split roughly 90% ACH, 10% card. And the yields on these products have remained relatively stable. We do, as you can see, have a track record of quite strong volume growth across both those products. And that comes from both new firm signups and the structural shift to adoption of online payments from our existing firms' clients. And we would expect that growth to continue. We've recently launched new firm onboarding processes. So when a new firm signs up, the process they go to activate has been totally restructured. And that will accelerate what we call the time to activation for new firms. So from a firm signing up to when they start processing transactions has been quite compressed. So we'll start to see that have an impact on our growth as well. In Australia, we make a small margin from payments. Pay Now payments. Most online options are free, and card surcharges basically just cover costs, but there is a small gross profit contribution in Australia. I'll hand back to Jennifer now to talk more about the US.
Great, thank you very much, Simon. Appreciate the time with all of you today and share with you some of the updates on the US business. Before I jump into those updates, I just wanted to quickly recap what we do and the markets that we serve. As many of you know, we offer two different types of payment options. Our Pay Now, which is ACH and card, both debit and credit, which are traditional digital payment options. We also offer Pay Over Time, which is our proprietary financing product, which I'll get into more details on shortly. All of our payment options are offered through a secure online payment platform, which I'm going to show you on the next slide. Finally, one of our key offerings, one that is a big competitive differentiator and makes QuickFee incredibly sticky to our customers, is our QuickFee Connect product. Connect provides a hook into leading practice management solutions, grabbing the invoice, putting a payment link on the invoice, and then sending it electronically. It also passes information on payments received back to the practice management solution, helping automate the bill to cash workflow and drive efficiency inside the firms. For those of you that haven't seen the simplicity of our offering, we thought we'd share the payment flow for one of our customers, Lally & Company, which is a Pittsburgh, Pennsylvania-based accounting firm. What you see on the left is the payment landing page on Lally's website. Regardless of which of the three options their client selects, it will take them to the QuickFee payment portal, which is shown on the right. The firm's client simply selects their payment preference, and it shows them the payment amount or amounts in the case of QuickFee Finance, including any surcharges or interest costs. I already shared how Connect is a competitive differentiator, but our other greatest competitive differentiator is our QuickFee Finance product. There's no other company that we run up against in the US market that offers a comparable solution. QuickFee Finance allows the firm to get paid in full, upfront, improving their cash flow, while allowing their clients to pay over time without any credit checks or a lengthy application process, also improving their clients' cash flow. It's a win-win for both the firm and their clients. I have a lot of updates on this slide, so bear with me for a moment. But we continue to stay the course on our plan for scalable growth in the US, and our laser focus on the right industries, accounting and legal, combined with our focus on the right activities, are paying off, and our momentum continues to build. First, we've had a significant focus on improving and optimizing our sales and customer success teams. As of August 1st, our sales team moved to a territory-based model, with each territory having an account executive focused on new customer acquisition and a relationship manager focused on increasing total transaction volume for their territory, with QuickFee Finance and Connect being their highest priorities. This territory model is supported by a new commission plan, which rewards for the results that have the highest impact. Additionally, as Simon shared, we have a new and improved onboarding process that accelerates the time to that very first transaction and provides a better customer experience. Second, we continue to have an amplified focus on strategic partnerships and alliances. Although our historical model of acquiring firms one at a time has been successful in delivering strong growth, We know that to achieve our aggressive targets and ambition, partnering with companies that will allow us to drive exponential growth through one-to-many partnerships is a game changer. In Q1, we announced 2 major strategic partnerships, being Alineo Global and Iris Software Group. Alineo Global is a member-based association dedicated to the success of independent accounting and consulting firms. Alineo Global is 261 members strong and growing, with locations throughout the world generating over 5.3 billion in collective revenues. By partnering with Alineo, we can not only build stronger relationships with our customers that are Alineo members, but we can also grow our own customer base while adding value to their membership. The second major partnership is with Iris Software Group, a leading global software provider of accounting and payroll solutions to over 5,000 customers in the United States, including 52 of the top 100 CPA firms. Our partnership with Iris entails us delivering both QuickFee Connect, which enables multiple payment methods through integrations with Iris's leading US practice management solutions, and also QuickFee Finance, which enables payment plans to Iris's customer base of accounting firms. Now, both of these partnerships are in their early days, but just this week we processed our very first QuickFee Finance transaction for Iris, and both partnerships are moving ahead quickly. In early October, I was thrilled to welcome Dave Moore to our leadership team as QuickFee's new Chief Technology Officer. Dave is an experienced technology leader in strategy, product development, cloud computing, big data, and machine learning. Dave's appointment as CTO represents a significant milestone for QuickFee as we strengthen our position as a leader in the financial technology industry. Dave was previously the Chief Innovation Officer at Growth Acceleration Partners, where he played a direct advisory role to companies in the process of digital transformation, helping them to modernize applications and leverage data in decision-making. Under Dave's leadership, our product and development teams continue to have a narrow focus on developing solutions that will have the greatest positive customer impact and unlock our ability to capture as much transaction volume as possible. This includes our Connect product and related practice management integrations, as well as a completely refreshed user interface and user experience. While we're accelerating our product roadmap, we are also being highly intentional about ensuring that we're doing it in the most cost-effective way. Finally, last month, we officially opened our new US headquarters in the Dallas-Fort Worth area, Plano to be specific. Being personally based in that office, I can speak to the energy, the momentum, and the quick decision-making that being in one place has enabled for a number of members of our team. Additionally, being centrally located means we can be anywhere in the US for customer meetings or events with one quick, direct flight, allowing us to better serve accountants and lawyers across the country. Now, before I hand it back over to Simon to share some of the information on the Australian business, I wanted to give you a quick peek into our new UI, which our product and development teams are working on. We're in the process of not only remaking our user interface and up-leveling our user experience, but we're also creating a significant step change in our solutions, including the development of a new client portal, which has been a consistent request from firms. Like everything we develop, this has been designed in close collaboration with our customers, getting their perspective and feedback every step of the way. As I shared earlier, our integrations with leading accounting practice management solutions through Connect gives us an advantage in the market while helping automate the bill-to-cash workflow within firms. Today, we have integrations with CCH Pro System Effects, CCH Access, and Iris Practice Engine. But as you can see here, we have many more integrations in progress and being planned, with Iris Star already well into development. Now I'll hand it back over to Simon to speak about the Australian business.
Thank you, Jennifer. So in Australia, as many of you would know, we have a solid base of accounting and legal firms. We share the market with 2 or 3 established players. Growth in lending is driven more by economic factors rather than any substantial shift in market share. Having said that, we have seen strong growth in our legal disbursement funding business. We've been offering this since 2014, and this product provides funding for disbursement costs for personal injury law firms, which are usually costs for medical reports in personal injury lawsuits. The one key difference about this product compared to funding, accounting and legal fees is that the interest compounds and there are no installments repaid during the term of the loan. The loan is repaid in full with all accrued interest at the earlier of when the case settles or after a maximum term of 24 to 30 months. So there are a high volume of quite low value loans, normally in the range $5,000 to $15,000 each, and no repayments during that term, but they're all repaid at the end when the case settles or at the maximum term length. The interest rates on this product are comparable to the fee funding product, but our funding requirement is higher because there are no repayments until the end of that loan. To date, we've funded approximately $5 million of the disbursement funding loan book from our internal cash resources. And as Dale mentioned, we're closing new debt funding to replenish this, and that will release approximately $4.3 million immediately of cash immediately back into the business with a new $10 million facility. And that is purely backed by the disbursement funding book in Australia. This facility will sit alongside the existing Northleaf facility. We expect this funding to close in the coming weeks, and particularly pleasing, it's not only a great endorsement of the actual disbursement funding product and our Australian operation in general, but it will also support further growth of this product in Australia, and it does provide the group with ample liquidity as we approach profitability. I'll pass back to Jennifer to wrap up now.
Great, thank you, Simon. As we wrap up today, I want to close with a recap of our highest level strategic priorities for the business in FY24, as well as our outlook for the year ahead. As you can see, our FY24 strategic priorities remain unchanged. Our number one responsibility and assurance to our shareholders is reaching profitability, which is mission critical. We will continue to manage our cash burn and be exceptionally diligent in managing our expenses. As I shared earlier, the opportunity in front of us is tremendous, and we're just getting started. Leveraging strategic partnerships to drive exponential versus transactional growth is a key part of our strategy. Finally, I want to assure you that continued enhancement to our systems redundancy and business continuity processes is always high on our list. After spending time with us today, walking through our Q1 FY24 business update and our FY24 strategic direction, I hope that you felt the excitement and the momentum that continues to build in both our Australian and our US businesses. We have the right people in the right seats to execute on our plan, and we're confident in our ability to continue to deliver strong growth, and we're tracking towards operating profitability within our existing cash and borrowing facilities. Now I'm going to hand it over to Katie, who's going to facilitate any questions that have come in or any questions that you may have.
Well, thank you, Jennifer, for the presentation, and Simon and Dale. And just a reminder to everybody on the call, if you'd like to ask a question, feel free to write it in the Q&A tab at the top of the screen. So we do actually have a question in the Q&A from Ryan. So Ryan's question is, I think, one for Simon. Are you still targeting positive EBITDA on a monthly, quarterly basis? And if so, by when do you expect to reach this?
Yeah, great question. And thank you for that. We did flag that we were targeting profitability for the month of June 2023, and we're about 55,000 shy of that. So pretty much on track for that. And that gave us confidence that, in the coming, year or two, we'll be able to post full year profitability. I think the business is quite seasonal. So for the first half of FY24, the 6 months that end December, we won't achieve profitability for that half. But going forward, we expect to certainly improve on that in H2, and then, following halves beyond that. So I can't give you any finite number exactly when we will be able to post a profitable half, but every half is, we're growing revenue on an ongoing basis, and costs are certainly coming down in certain areas. So it's we should be there in the very short term in terms of operating profitability, i.e. cash EBITDA, and certainly by June 2024 on an ongoing basis, we'll be able to certainly be able to give some very positive news around that.
Okay, great. Thanks, Simon. We've got another question on the net debt. So that has increased to 29 million. How do you think about the optimal level of debt for the business, and when do you expect to get there to the optimal level of debt? I think the question is.
Yeah, I think given we're a business that effectively operates on borrowing money to lend money, the more our loan book grows, the more we will need to fund that with borrowing. So there isn't really an optimal level. If our loan book grows substantially in the US through some of these partnerships, we will fund that largely by borrowings. It's a good problem to have. Debt is part of our business model. Yes.
Yeah, makes sense. Okay, I've got some questions coming through in different ways. So I've got a question here. Great update, thanks. With respect to the integrations, the August update showed a number of additional planned integrations. How are they progressing? That could be one for Jennifer.
Sure. Yeah, I'll take that one. So the integrations are progressing. They're progressing well. I think part of our development process is, as we rolled out our first 3 integrations, we had feedback from customers around enhancements they'd like to see or improvements to the existing integrations. So we made a deliberate decision that rather than to race through and check a box and get them all stood up, is that we were going to be very deliberate about making sure that the customer integrations that we built had gone as deep as they would like them to be, and that they're serving and meeting the customer needs. So we're continuing to do that, but we are on track. We are working on Iris Star right now, and then Thomson Practice CS is right after that. So we're progressing well, but we ended up going deeper on some of the integrations than initially planned.
Okay, thank you. Got another question here on the appointment of Dave Moore as the Chief Technology Officer. It was in your presentation, Jennifer. Obviously early days, but what are the initial priorities for Dave and his team?
Yeah, thank you. So, I think that probably the number one priority for Dave is around, obviously meeting customer needs, but figuring out how we're going to do that in the most efficient way. Probably the number one focus is around increasing the automation that we offer in our solutions. Getting the right talent is a key issue inside firms right now, and they're looking to solve some of that talent shortage through automation and increased efficiency. And so that's a huge area of focus for him as we look to meet our customer needs.
Okay, thank you. You talked a lot in your presentation about the strategic partnerships. Do you have, what's the pipeline looking like in terms of strategic partnerships?
Yes, it's that question makes me smile. I think that we're doing great. We talked earlier about how we'd hired Rafael Casas to help take charge in this area, and he's been doing an exceptional job. He's moving very fast. Some days as I'm in meetings or working on stuff, the updates that are coming in from him are kind of fast and furious, and there's a lot going on in the market and generating a lot of activity and interest. And we feel like we're getting a lot of good momentum in that area. So certainly, you should be seeing consistent announcements and updates around progress with additional partnerships in the near future.
Okay, thank you. Then I've got a question.
Katie, just to further on that, I think the important thing for investors to kind of be mindful of is our strategy is to make sure that we maximize the value in individual partnerships, not just build as many as we possibly can. I think we've certainly my experience, and I know shared experience with Jennifer and the team, is the success of a partnership is your ability to penetrate into that client base, and that takes time and effort and energy. I think if you spread yourself too thin across too many different partnerships, you can kind of step back from it and not generate the results, and therefore the investment that you're making in each of those is not really producing what you're after. So I think it's kind of a balance of being able to identify the right partners, executing the right commercial arrangements with those partners, such that you can you can have a willing partner on the other side of the table that can actually allow you to open up that client base. So it's a bit of a balance between how many and how wide you go and the depth that you can go with individual ones.
Great points, Dale.
Yeah, thanks, Dale. We've got a question for Simon on the new disbursement funding about the likely impact on margin of the new funding.
I'd expect the margin to stay relatively stable, actually. The disbursement funding product, the rates are broadly comparable with our fee funding product because of the compounding interest, they're probably slightly higher. And the cost of funds is again slightly higher than Northleaf, so it should equalise out reasonably the same. So we shouldn't see any demonstrable change in the margin.
Okay, thank you. And could be another one question here for you, Simon, on delinquencies. I know previously you've reported, very low delinquencies. Have you seen that that change? And then a follow-up question for Jennifer about the territory model in sales, and how do you think that will impact the sales and also on the team size, planned staff increases or potential? So Simon, perhaps you take it first.
Yeah. Delinquencies, you do see a slight increase in arrears and what we call dishonours, because with instalments we direct debit all the clients themselves. So every day we'll run a debit file pulling money from clients' accounts. The level of dishonours has increased slightly, but it's comparable with the level of lending and the size of the loan book. So it has, as a percentage, it hasn't gone up. But in terms of actual delinquencies and write-offs, again, they're very, very low, simply because you need both the client and the firm to default for any actual credit loss to crystallise. And our processes, we look at every single loan on a loan by loan basis to assess it and monitor it for any arrears. So it's we've got robust processes in place and a pretty strong business model there. As the economy continues to tighten and inflation bites and interest rates go up, we see demand growing, but it just means we have to be even more rigorous in terms of our credit processes, which we will continue to be.
And I'll take the second part of that question, Katie, around the territory model and when we expect to see that have a impact on our numbers and the team growth. I think that we're already seeing the territory model have an impact on the numbers, especially on the relationship management side, when they own a growth number specific to their territory as it relates to not only Connect signups, but onboarding new customers and our QuickFee Finance growth in their territory. It's not everyone's kind of together and one person's pulling the weight or someone isn't performing. It's like when they own a very specific territory, that accountability is really clear. And we're seeing that already not only play out in the numbers and the results, but also in the behaviors and the activities and their own ownership of their respective territories. So I think we're starting to see that. As far as the team size growing further, we don't have immediate plans that we need to grow the team size. We've actually put in some really smart technology to help us better manage our sales processes so we can increase our productivity and efficiency in a cost-effective way versus hiring more people. And so the reps that we have, both our account executives and relationship managers, their level of efficiency has increased dramatically over the last 90 days. And that's made a significant impact and given us some headroom before we feel the need to hire more.
Okay.
Yeah, I think it's worth adding that while we are, very, very focused on hitting profitability, we're not going to stop investing in areas that can generate revenue for us. So if we need to put on an extra salesperson or we need to invest in, say, accelerating Connect rollouts, we will do that. We're not going to harm the business just to hit that. But we are, revenue is growing, and we are got a real focus on containing costs at the same time.
Okay, thanks, Simon. That's all of the questions that I can see have come through. So we might wrap up the webinar for today. Thank you everybody for attending. It's a really informative update and great to see the positive momentum in the business. And we are running the webinars post all of our results. So the next investor webinar will be early next year. And we look forward to updating you on the first half results.
Great.
Excellent.
Thank you.
Thanks.
Thank you everyone
Katie.
for joining.
Thanks, everyone.
Thanks, everyone.
Thanks. Bye.